Hey guys, Joe Jacobs, mortgage broker over here with Intention Financial Group, and I'm excited to finally be able to talk a little bit more about the CalHFA Dream for All program and let you guys in on what it's really all about, some more details, but most importantly, the best thing that you can do is schedule a consultation one-on-one with me or anybody over here at Intention Financial Group who can actually go deep with you on this because everybody's situation is unique. But here's the basic eligibility criteria you want to think about. So number one is you need to be a first-time home buyer. So that doesn't mean you can't have ever owned a home in the past. It just means that within the past 3 years, you actually haven't owned a home. The second thing is that you cannot use a co-signer or somebody that's going to be a non-occupant co-borrower, right? So that's something that's a little bit different about this program. So you have to qualify on your own if you're going to be living in this property. There's also 2 levels of homebuyer education counseling that needs to be completed through CalHFA. So there's a couple of resources that I will put in this post so that you can see, but very important that you go ahead and get on top of that right away if you want to get that all knocked out. So talking a little bit about the income guidelines, it's going to vary county by county. Here in Sonoma County, that's about $223,000, roughly $18,000 or so dollars a month in terms of your income. Like I said, it changes county by county, but that's a very generous amount. The other thing that you'll want to consider is that there's 2 segments of this program. The first segment is going to be an LMI, which is a low to moderate income bracket, which is going to be a little bit more flexible on your credit score because you can start at 660 and a little bit more flexible on the amount of shared appreciation that you have to do with the state of California. And I'll talk about that in a second. And then also a little bit better of a rate for that. The second bracket is going to be your standard CalHFA Dream for All program, which starts at a minimum credit score of 680. And then goes up from there. That's going to be a slightly higher rate, and I'll talk about rates in a moment because basically the rates are going to be directly on the CalHFA website. But what's also important to understand is depending on your credit score, if you have between a 680 and a 700, that means your debt to income ratio needs to be lower 45%, meaning that your total monthly debts compared to your income has to be lower. So it's a little bit more stringent if your credit score is between 680 and 700. If it is above 700, then you can go up to 50%, basically a little bit more lenient there. Another little thing about this is that you have to get a home warranty for 1 year when you get into contract and close on that. Has to cover water heater, air conditioning, heating, oven, stove, and range. So important to understand that. And then basically the other piece is that you kind of want you to understand a little bit about this application process. So the way it works is CalHFA is not actually your lender. What they are is they work with various lenders out in the community, and they are the ones who are distributing their funds. So luckily, we have relationships with wholesale lenders that do have access to this program. So it's very important that you understand that this program is really similar to your regular pre-approval process. It's just that once you get into contract and you start going, you are going to have an extra layer where CalHFA will basically look at this loan and underwrite it as well. The other piece is to understand is that interest rates for this program are going to have 2 different categories. You're going to have your low to moderate income, and then you're going to have your standard. The standard is going to be a slightly higher interest rate, and then your low to moderate income is going to be a little bit less. And then understand that all lenders that offer this program get their rates directly through CalHFA. So you're not going to be comparing rates between different lenders because they're all going to be offering the same rate. The next thing is that there is no advanced way to reserve these funds. Essentially, what you need to do is complete the homebuyer education and get into contract. It's basically first come, first serve. Once you get into contract, you go through the formal underwriting process. CalHFA will also look at it to make sure it meets their guidelines, and then you're basically good to go. So real quick, I want to talk a little bit about the shared appreciation part of this. As I alluded to earlier, for the people that are in that low to moderate income, they're going to be sharing 15% of any gained equity that borrower gets over time when they go to sell the house. Whereas people who have the standard income, they share 20% of the accumulated equity until they sell the house or refinance the house. The other thing about selling the house or refinancing the house is that I actually have a calculator that you could use that could help you see under certain situations how long you keep the house and rates of appreciation, what that shared equity might actually look like. One of the cool features that just came out about this program too is that they will actually allow for a borrower to potentially have at least one refinance during this process and be able to keep that second loan, the 20%, which is basically a silent second because you don't make any payments on that or pay any interest. So there is an opportunity, if rates go down in the market, that you could actually refinance and get that 30-year fixed rate lower. So that's a pretty cool benefit that we weren't necessarily expecting. So again, the spreadsheet will really help in our one-on-one consultation if I share that with you and go through that. But I think it's just important to remember that there's limited funds in this program. So originally there was talk about it being $500 million, and now they are actually allocated $300 million for 2023. So if you do the math, depending on what the average down payment is, but I can tell you probably the average home around here is going to be anywhere from, $7 to $750, right? So if you do that math, that's going to be anywhere from about 2,000 to maybe 2,500 purchases in the state of California. So because these funds are limited, it's important to understand that you really want to get all your ducks in a row, get all your paperwork together for your lender, get the homebuyer education complete, and then most importantly, go out there and write offers on homes that meet your criteria, work with your realtor, and make sure that your realtor is working directly with that lender and in very tight communication. Then also, there is a way to look at this so that you can get in with literally 0% down, like zero funds down, should I say. But it's a matter of structuring your loan appropriately so that you can do that. So just because you're getting 20% doesn't mean that you can use it, that you would use it all for the down payment, because there's closing costs that are going to range anywhere from 3 to maybe 4.5% on this by the time you include everything. You're just as a rough budget, you can actually use part of those funds. You can use up to 5% of those funds to allocate for those costs, which is nice because essentially you can get in and get in with close to nothing down, nothing at all at closing, if you structure it right. Now, that would make you'd have to be flexible on your payment, because by doing that, you're still taking a little bit of mortgage insurance. But if your credit is good, that mortgage insurance premium should be good, because technically you're not quite putting down 20%, because it's more valuable for you to hold on to your cash now. So what I'll say is that I have a loan comparison tool that will allow you to look at things side by side. So all you need to do is decide. It's like a teeter-totter. On one side, you have payment. On one side, you have cash to close. And if you want to come up with some more cash, your payment will go lower. And if you want to come up with less down, your payment will be higher. And that's up to you. So however you want to structure that loan, it's just a matter of us quarterbacking that out once you are going through the pre-approval process. But anyways, now that the program is here, I wanted to lay out all the important information. As new information comes in, we will be sure to share it. But if you have any questions, I do encourage reach out via email, text, phone call. I have a link to my bio, which has the ability to schedule a consultation. It'll smart read my calendar, and we can just go deep on the process. So anyways, hopefully you found this information useful, and have a great day.